It is often said, if you don't hold it, you don't own it. Why are both physical and digital assets important for your retirement? With a 2% target as the Fed's ultimate goal, not zero, that means a 2% loss of your wealth year over year. Ultimately, what the Fed chairman sees in the economic tea leaves is not within your control. However, protection of your retirement savings is in your control. If you think you may be falling behind in your financial goals, see the video description to access the free Inflation Retirement Calculator to make sure that you are on track. To better understand the necessity of real tangible assets for wealth preservation, we will hear from economist, White House advisor, and author Jim Rickards, macro analyst and investor Lyn Alden, economist and investor Keith Weiner.
Gold is a unique commodity, and I do think money has to be a commodity. Wenger talks about marketability. Gold is the most marketable commodity by far, with silver being a distant second and everything being distant third behind silver. Silver actually serves a different purpose than gold. So gold is great at carrying value over distance. There can't be a local glut in one market and a shortage in another, because most major places in the world are no more than a 24-hour plane trip to anywhere else in the world. Gold is actually pretty cheap to transport. Silver, if you look at the evolution in markets, there tends to be a winner-take-all dynamic. Silver is the most marketable in the small. That is, if you're a wage earner and you want to save 10% of your weekly wage, and look at that today. So that might mean somebody saving $50 a week today. Physical gold is very impractical in that size, because you're going to pay a gigantic premium to manufacture something with that precision to get down to that size. If you want $50 worth of silver, you're talking roughly 3 1-ounce coins worth. And so silver, you experience less losses if you're the wage earner trying to buy $50 worth of silver. And historically, that was always so. So silver is more marketable in the kind of quantities of somebody buying, with their weekly wage, or selling a little bit for groceries in their retirement.
I'm not talking about e-gold. I'm not talking about COMEX futures. I'm not talking about GLD. I'm not talking about ETFs. I'm talking about gold. So gold is no one's liability. I think no one's done a better job than the Austrians of pointing that out. It's the only form of money that's not a liability. You say, what's a dollar or a pound sterling? I learned in the first week of law school, if you have a contract, you're supposed to read the contract. Take a dollar bill out of your wallet, or take a pound sterling, and look at what it says. Look at the writing. That's the contract. It says it's a note. It's a Bank of England note, or in the case of US dollars, a Federal Reserve note. Where I went to law school, a note is a liability. Indeed, if you look at the balance sheet of a central bank, the money that they've created is listed on the liability side of the balance sheet.
And look back, in history during prior inflationary episodes in the market, and we see that there are very different types of responses depending on how much debt is in the system. And so when we think of high inflation, we often think of the 1970s. I use 3-month treasury bills as a proxy for short-term rates here, because the data set goes back really far. But essentially what you had here was the Federal Reserve was constantly trying to tighten and raise rates to rein in inflation. And they were able to do that in large part because debt as a percentage of GDP, both in the public debt and private debt, including household debt, corporate debt, all the different types of debt outstanding, they were pretty low. And so they were able to raise rates, and it caused economic weakness, didn't necessarily cause like a solvency event. Whereas back in the 1940s was the last time debt as a percentage of GDP was as high as it is now. You had a pretty big decoupling in terms of inflation and interest rate policy. And so I think a lot of macro indicators show that the 2020s are shaping up to be very similar. We already had this big spike here. We had the largest ever decoupling in terms of inflation and rates since the 1950s, and I think we're going to get probably more cycles of that going forward.
Just a quick interruption to say thank you for supporting our channel. Please like and subscribe if you enjoy this video content. It really does make a difference. Also, a quick mention and shout out to one of our sponsors, Birch Gold Group. With over 3 decades in the industry, Birch Gold Group is one of the most trusted companies for gold investing. Whether you are starting a brand new gold IRA or rolling over an existing account, the company will make this process seamless and stress-free. With endorsements from respected and renowned voices across America and one of the lowest investment minimums in the gold IRA industry, Birch Gold Group makes it easy to get started investing in precious metals. To find out more about Birch Gold Group and how this trusted gold investment company can help safeguard your coveted retirement savings, see the link in the video description to visit Birch Gold's official site to receive a free gold investing guide. Also, check out our video review of Birch Gold Group by clicking the link in the top right. Now back to the episode.
These arguments against gold that I shoot down in my book, I may shoot them down, but you still hear them. You hear them from scholars. You hear them. It's not just sort of the everyday citizen is repeating something they may have picked up. I mean, you hear PhDs, you hear prominent public officials, certainly television personalities, and others repeating these things. And I say to myself, well, where did they get this? And I know where they got it. They got it from the elites who like the central bank system. And think about it. If you were a PhD from MIT on the board of governors, or maybe the chairman of a central bank, why would you have anything good to say about gold? You control the printing press. You control money. Anyone who controls money controls politics, controls culture, controls the world to some extent. So this is a very small club. They were all taught the same thing. They all believe the same thing. And collectively, they control not just the dollar printing press, but all the printing presses in the world. Why on earth would they want to give up that power?
Almost every single developed country today developed back under a hard money standard, back under when gold was money. People were able to save money reliably and then deploy that capital. In terms of the monetary system, what makes a European country or America or Canada or Australia or Japan, what makes them different than the Brazils of the world or the South Africas of the world or other countries like that, is that those developing countries, nobody really wants to lend to them in their own currency. And so they lend to them in dollars or euros, usually dollars. And so these countries have dollar-denominated debt. And the challenge there is that any time the United States can harden that debt, they can just jack rates from 0 to 6% and do quantitative tightening and just kind of basically try to break that country and damage them and then get concessions from them. Or if there's a lot of other countries that are saving in treasuries, they build up huge trade surpluses, we can devalue them. We can kind of rug pull the savings if we find that it's in the United States' best interest. And so we kind of push a lot of this volatility out into the rest of the world.
Something doesn't teleport from 0 to ta-da, money without skipping. Why would anybody have wanted to hoard it in the first place before it was money? It had some other value. So the first gold coin, I think, was coined in the Kingdom of Lydia, which is now in Turkey, if I want to say. And that was around 600 and something BC, if I remember. So before that, they had alloys of gold and silver called electrum. They, of course, traded the metal in non-coin form. Coins make the metal more fungible because they're readily recognizable. The weights are standard. There's a hallmark on there that, nobody's going to be counterfeiting something with the king's mark on it, at the risk of having his head chopped off in those days. Gold is a unique commodity, and I do think money has to be a commodity. We're physical beings who live in a physical world, and there are certain times at which nothing less than I want final delivery of the goods. No electronic or paper representation or promise or receipt is good enough. I want to hold something in my hand and take it home and take my marbles out of the sandbox and go home. And so it has to be a physical commodity. And then of all the physical commodities, gold has been the one that's selected.
I've been using the 1940s to characterize this era more so than the 70s, which is kind of the popular conception right now. They had fewer assets available to them because gold was illegal to own for Americans. Many, foreign pools of capital went into places like gold where they could. Commodities did well, broad commodities, silver, oil. Equities were very volatile in that period because you obviously had a lot of uncertainty, and equities are long duration assets, and so it's hard to price them appropriately when you don't know the economic outlook. And luckily now, even though we're in some ways going through a similar macroeconomic cycle as the 40s, investors have more tools available to protect their capital against these periods of currency devaluation that you can go through when you have that combination of high debt.
Gold holds a proven, time-tested track record as an economic constant that spans millennia. Why is it important to have an economic constant? What is the main question every person planning their retirement or building a business needs to ask themselves? Are we growing wealth or losing wealth? And how do we measure this? Gold is that tool. With a 5,000-year record that has withstood every economic business cycle, stock market booms and busts, global conflicts, and outlasting every faith-based fiat currency, gold is no one's liability. It builds wealth while preserving it. Owning physical gold and precious metals requires responsible sourcing of grades, purity, condition, the best prices, transparency, and most of all, security and storage. Gold IRAs are a tax-deferred means of owning physical gold and ensuring all these investing principles are met. We have reviewed and vetted the best gold IRA companies that meet all these requirements. See the link in the video description to access the free gold investment guides. If you have $100K of retirement savings to protect and want to take advantage of the best gold prices, see the link in the video description to sign up for the free Gold and Silver Web Conference hosted by Augusta Precious Metals. Thank you for watching.